Hey everyone! Welcome back to the channel. Today we're diving into a massive new tax proposal that's grabbing headlines. If it passes, what does it really mean for you? Will it put more money in your pocket, or take more out? Will your paycheck stretch further, or will you be footing the bill for someone else? Let's break it all down. I'll walk you through how this bill could affect Americans at every income level, using real-life examples so you can figure out exactly where you stand. While the headlines highlight some exciting perks, there's more to the story, including how it's paid for, who gets temporary relief, and who walks away with permanent wins. Overview. This bill is designed to offer tax benefits across income levels, but the type and duration of those benefits depend on your unique situation. Let's walk through three main income brackets, and I'll throw in a bonus example of someone who doesn't benefit at all. 1. Lower to modest income earners. If you earn a lower or modest income, especially hourly wages, this bill might be a big win. Key benefits include: no taxes on overtime. If you're under the income threshold, tax-free tips for service industry workers, higher standard deduction through 2028, charitable deduction for non-itemizers up to $150. Example. Let's say you're single, earning $40,000 a year, no kids. Currently, you get a $15,000 standard deduction. Under this bill, that bumps to $16,000, saving you about $120. If you earn overtime or tips, that money could be completely tax-free. Add in retirement savings or charitable donations and your yearly tax savings could land between $250 and $800 depending on your situation. 2. Middle-class families with children. This group sees some of the most immediate benefits, but many of them are temporary. What's included? Child tax credit increase from $2,000 to $2,500, 2025 to 2028 only. Standard deduction bump for joint filers, from $30,000 to $32,000, tax-free overtime and tips. New mega accounts for children's future expenses like college, business, or home buying. Potential car loan interest deduction. Example. A married couple with 2 kids earning $85,000 gets a $2,000 bump in their standard deduction, saving about $240. Their child tax credit increases from $4,000 to $5,000. With overtime and mega contributions, their total tax savings could range from $3,500 to $6,000 per year. 3. High-income earners and business owners. This group receives the most permanent and substantial benefits. Highlights include: QBI deduction increases from 20% to 23%, and its permanent estate tax exemption raised to $30 million for married couples. Alternative minimum tax relief locked-in standard deduction bump remains in place. Example. A married couple earning $200,000 with one spouse owning a business sees their QBI deduction increase, reducing taxable income. Add in a $480 bump from the standard deduction and permanent estate planning tools, and their annual savings could range from $6,000 to over $12,000, depending on their setup. 4. Who doesn't benefit? Let's talk about who might not gain anything at all. Example. A single part-time worker earning $22,000 a year with no kids, no overtime, no tips, no charitable donations, and no retirement contributions. They already pay little to no federal tax, and they don't qualify for most of the bill's benefits. Their total gain? $0. Category breakdown. Here's a quick look at how the bill distributes its benefits. Business owners. Permanent QBI boost, estate tax exemption, bonus depreciation. Wage earners. Tax-free overtime and tips, higher standard deduction, savers credit. Parents. Higher child tax credit, mega accounts, temporary perks. Seniors. Less than $75,000 income. New $4,000 deduction. Low-income workers. Modest credits, if they qualify. Investors and estate planners. Long-term tax planning advantages. What lasts, what doesn't? Not all tax breaks are built to last. Business owners and high earners get the longest-lasting benefits. Middle-income families get meaningful, but short-lived, savings. Modest earners may benefit, especially with tips, overtime. But those gains expire after 2028. This structure raises real questions about fairness. Middle-income families get tax cuts that fade, while high earners lock in permanent gains. Is that fair? Depends on your perspective. Final thoughts. Bottom line, yes, there are tax cuts here for nearly everyone. But there are no matching spending cuts, which increases pressure on the national debt. That's a serious long-term concern. Some provisions, like clean energy incentives and education credits, are being rolled back, which could negatively affect certain sectors. And while the bill simplifies parts of the tax code, it also adds new complexity, income phase-outs, new account types, and temporary perks that expire. This bill reflects a particular political vision. If you support smaller government and lower taxes, you'll probably like a lot of this. If you believe in stronger public investment and progressive taxes, you may see this as tilted toward the wealthy. Neither view is wrong, it just depends on your values. If passed, this bill could reshape how Americans experience taxes for years to come. Families with kids might win big in the short term, but business owners and the wealthy walk away with the real long-term advantages. Will this pass in its current form? That's up to Congress. But now you know what's in it, and you're ahead of the game. Let me know what you think in the comments. If you found this helpful, give it a like and consider subscribing. And if someone you know might benefit from this info, share it with them. I post new videos weekly. See you next time.